US, and also in the last 6 months, they've done about 11 early stage investments here in India, and they are on track to do and probably be one of the biggest early stage investors in India on the product side alone. Paul by himself has an excellent background. He's been an entrepreneur before. He's also been an investor, so he sees both sides of the story. And I think it'll be an excellent session for you guys. Without any further ado, I'm going to take it over to Paul.
Thanks, man. I know that I'm probably all that's standing between you and lunchtime now, so I'll make this good for you. So what we're going to talk about today is the quantitative strategy behind our own approach. Everything I'm going to tell you is not really theory. We actually use this. We have used this to make over 400 investments in 20 countries in the last 2 years. And to give you some context here, we're talking about real money. We recently had one of our largest exits. We have 15 exits to date. One of our largest exits was about a month ago. It was about $500 million to Google. Right? So again, this is not theory. This is actually real stuff. And I hope that for the founders in here, you learn kind of a little bit more about how the investor mindset has changed. And for the investors in here, I hope that you pick up some tips that might help your own portfolios. I am going to move pretty quick, but if you have any questions, feel free to interrupt. Just speak out. We'll work through it together. This talk is usually about 2 to 3 hours, and we're going to try to condense it down into an hour. But I'll be around until Friday if you guys have any questions about any of this stuff. So again, 500 startups. We are headquartered in Silicon Valley. I'm a partner there alongside my partners Dave McClure and Christine Tsai. More recently, we actually have added about 5 venture partners to our investment team. One of those is based here in New Delhi. I myself come into the country every 45 to 60 days. You will see a lot of us here. As Mukund was saying, we started investing in India about 6 months ago. We've made about 10 investments here. I expect that we'll likely do 30 to 50 new investments every year, just in India alone. But again, to give you some context, we do one new deal somewhere on the planet about every 48 hours. Right? So we're pretty aggressive. By the way, all the slides are available online. So if you go to my Twitter handle, Paul Singh, you'll see that I just tweeted them out. You can download these, do whatever you like with them. I'm pretty easy to reach as well, paul@500startups.com. So first, let me start with an idea, right? And that idea is the one that's something I've been thinking about for a few years and is kind of the underlying thread, if you will, with this entire thesis. And that is that we must all become an API to venture capital and functional expertise. So for those of you that don't understand that word, let's just replace the word API with bridge. And then what you'll find is that this means something different for founders, investors, and for those of you in government and policy as well, it's a little bit different. So for founders in the room, your sole job in life is to build something people want. That's it. Don't worry about trying to make your community better. Don't worry about trying to do anything else. If you can't do this, you will not be able to help your community. You will not be able to help your fellow founders. You won't be able to do anything. Investors, we're going to spend a lot of time talking about this, but in general, you need to write checks. If you're not writing checks, don't feel bad about it, but don't waste anybody's time. And once you write that check, you need to add value. Right? And I'll show you how we add that value as well. And then for anybody on the government and policy side, it's really important that you make it easy for investors and founders to work together. I myself am actually a special federal employee of the Homeland Security Department in the United States, where I work mostly on immigration policy. I effectively trade our data around economic development and job creation for more visas for our founders. You guys can do the same here, but that's probably a different talk. So let's start by one of the quotes that actually got me thinking about this whole thesis. And it was written or said actually by a good friend of mine who I don't think he even remembers saying this, but about 3 years ago I was watching Naval from AngelList speak in Texas. And what he had said was venture capital is open to attack by disruptive new business models in tech. And that sort of started the gears moving in my head down this path. Also, a lot of the stuff that I'm going to talk about here, I read a lot. I'm on an airplane pretty much every other day, but I read a lot. These 4 books are really pivotal to everything we're going to talk about as well. So if any of you are readers out there, I'd encourage you to pick these up. Little Bets on the End there, I think, is a really good one that is sort of sneaking by under the radar that nobody really talks about, unfortunately, but it's a great book. So let's start with the first cliche, which is early stage startups have already changed. To give you some context here, by the way, I'm going to first talk about how the ecosystem has changed for startups. I'm going to use that as a way to then set the stage for why we have to adapt as investors. Okay? So early stage startups have already changed. The first big change has been that startup costs are lower than ever. I think I see a few of you nodding so you understand. But the fact of the matter is that when I started my first business about 12 or 13 years ago, you basically needed 10, 15 million bucks to start. Right? But just for the sake of this analogy, let me just say it took you 5 million to start. Because before you could even build anything on the internet, you had to buy a server, find a rack, stick it in, and then stick an Ethernet cable in the back. Right? And some of you may or may not remember that. These are like pre-Wi-Fi days. But then all of a sudden, open source software came in 2002. All of a sudden, 500K was the new 5 million. Right? You didn't have to buy expensive licenses. You could now use Linux to host your systems. Around 2007 was the next pivotal change where the cloud started taking traction. All of a sudden, $50,000 was the new 500,000. Right? And today, figuratively, 5,000 bucks is all it really takes to start. I'm going to make this point again later, but I will just plant the seed in your head. For you investors out there, you should never, ever, ever invest in an idea. And founders, if you're going to go raise money, never waste time until you've launched a product. Because you actually have no excuse to not launch. The next big change has been that as the web gets bigger, the world is getting smaller. I think you guys would all agree with me that the number of people that fund companies is far less or far smaller than the number of people wanting money. Right? Everybody agrees, right? All right, so here's the problem for you as founders, by the way. As internet penetration rises, even here in India, all of a sudden there's more entrepreneurs that want money, right? So you must launch. You must have traction, and you better learn to communicate. You better learn to communicate. The fact of the matter is that if you thought you were going to get 10 minutes with an investor, you will if you're lucky if you got one. Because it's not that you're a bad person, it's just that there's a lot of deals out there right now. So again, as the web gets bigger, the world gets smaller. This is a big idea here, I think. It used to be that tech mattered, right? Technology mattered. I'm going to just make an assertion to you, investors. If a founder comes to you with an internet startup and they say anything about a patent, you should run. You should run. Because tech differentiation does not matter anymore. What matters is traction. Right? One of the questions I always bring up to the audience when I say this is, why is it that nobody's kind of created another Facebook or another Twitter? Why is it? Anybody? It's not a trick question. Nobody. Both are right, but let me rephrase it. Today, 1 out of every 7 people on the planet uses Facebook. It's overwhelming traction. Overwhelming traction. That is the only defense you have today. It doesn't matter whether you're an enterprise company, B2B, B2C, whatever. If you can't figure out how to get your business an inch off the ground, God help you. That's it. Traction is the new intellectual property. The fact is, the platforms today, the search, social, and mobile platforms today, are giving founders access to customers in an unprecedented way. The next big change has been that capital is increasingly commoditized. The fact of the matter is, all of our money is the same, investors. Right? My money came from the same Treasury Department as yours, probably. Right? And the fact is that we need to recognize that, because if you don't, you're going to get undercut. The reality is that early stage money is following founders. In other words, do not sit in your home office thinking that you will invest in a 5-kilometer radius from your house or 50-kilometer radius from your house. Because that has an underlying assumption that that region will generate the best founders. That's not true. I fly 250,000 miles a year, and that's not a badge of honor. That's the new reality of early stage investing. The best founders in the world are not in your backyard. Right? But they are here somewhere in India. I don't know yet. Give me a year. I'll find them. Right? But they're here. And the biggest change that's happened in the early stage startup world is that signals exist. Right? So what I mean by that is that we're all, as investors, we're all familiar with the idea of pattern recognition. We understand that investing is typically a qualitative decision. It's I feel good. This guy was referred by that guy, right? It's based on that. And then we might kind of convince ourselves that we've done some sort of due diligence, but I'm going to make the case for why most of that's broken anyway for early stage. But the point is that big data, open source analytics, and open source analytics are opening up way, way new techniques for venture capital. So let me start by giving you two examples. Okay? First of all, I think everybody would agree with me that venture capital is a small part of the larger piece of private equity, right? Okay, so private equity would be things like Wall Street, bonds, commodities, right? Everybody agrees, right? Okay, so here's the fact. Wall Street already beat us to it. And I know I'm rushing through it. We're on a short time schedule, but we can talk about it if you guys have questions. But I'm going to make the assertion here that Wall Street was forced to innovate faster than venture capital. Why? Does anybody have any ideas why? Why was Wall Street forced to innovate faster than us? My investors are pretty demanding. Say again?
They're reviewed every quarter.
They're reviewed every hour, every millisecond. When you make a trade on the public markets, within seconds, that trade either lost you money or made you money, right? It could. It might take a day, it might take an hour, it might take a minute. The point is that the delta between when you made that trade and when you feel the pain or the glory is very small. Now, in venture capital, typically we don't know the outcome of our companies, positive or negative, until about 2.5 years later. So the delta is big, right? Now, anybody know what this is? You might have seen these pictures before. Does anybody recognize them? Parking lot of... These got a lot of press, actually, last year. Okay, that's okay. I'll tell you. So these are the parking lots at Walmart. Just two of them. And what this is that UBS, which is a large publicly traded bank, global bank, as part of their trading division, they make bets on these public market companies, right? So they have all these analysts that actually sit there and figure out, hey, should we buy, should we sell, should we do all this other stuff? There's a lot of qualitative stuff there, right? But what if I told you that what they actually also have in their data models is that they have contracts with satellite operators to take pictures of every parking lot of every Walmart every hour and count the vehicle turnover? The reason they had to disclose this, one of the reasons they had to disclose this was because they made a big buy before the earnings call sometime last year. And they did a big sell afterwards. Why? Because they could predict, their many data points showed that there was a higher vehicle turnover count in that previous quarter, which means more people through the door probably means more sales, right? I see a lot of you nodding because you're like, oh, geez, this is so obvious. Okay? Anybody recognize this? Let me make the assertion, by the way, that picture on the right is the only one I could find about this story I'm about to tell you. Oil storage. Okay, in the U.S., we have the U.S. Mercantile Exchange, right? And so in our news every day, you'll hear about the price of the oil barrel, right? Now that oil barrel, that oil that's traded on the Mercantile Exchange is all stored in the largest facility in America called Cushing's, Oklahoma. All the oil in those tanks on the left there is the oil that's traded on the public markets, right? Now, the picture on the right is a close-up of the roof of one of those tanks. The reason you can't see it in the big picture on the left is that there's a net now over the top of those tanks. That roof on these oil tanks is floating. And what if I told you that twice a week, helicopters fly over those tanks to see if the roof moved up or down? Because if the roof moves up, oil is coming off the market, which means what? Price, what will happen to price if it goes up, right? Everybody agrees? And if that roof goes down, that means oil is being pumped to the market and price will go down. Supply and demand, right? In addition to having helicopters, these guys, Genscape is the company that does this. This is publicly known. They actually also have electromagnetic sensors on the power lines outside the pumping stations, right? They're measuring everything. And the thing is, Wall Street isn't alone. If any of you have ever gotten a loan for a car, for in vitro fertilization, for anything, you were part of a big data model. This is not like science fiction. This is real. This is today. This is happening. And if you don't agree, you're losing. You're not going to, you might as well just walk away now because you won't agree with everything else I'm about to say. The point I just want to make here is that the public markets are already doing what I'm going to tell you that we do as well. Right? So, everybody recognizes these logos, right? What if I told you that, what if I reminded you that most of you have been on most of these platforms for at least a year, if not 5 years, right? So why does that data matter? Well, I'm going to show you 3 ways I use that data. All right, so sentiment analysis. So let's say a founder walks up to me and says, hey, I got this team, we're great, you should invest in us, right? Well, one of the things I can do, in addition to saying, hey, tell me about your background, tell me whatever, is I can actually go back to Facebook, to Twitter, to Quora, and I can see when the founders met, how often they communicate, how often they're tagged in photos together, what the sentiment and frequency of those interactions are. That tells me something more than the qualitative, hey, we're good friends, right? Does everybody agree? The other thing as an investor that it gives me is I'm watching all of you in the sense that when there's a founder raising money, that founder is probably talking to multiple investors, right? Founders, you agree, right? You're not just talking to one investor when you're raising money, right? Okay, so now the next thing I can use this for is for finding that needle in the haystack, finding that founder that is able to actually generate the heat to raise money. Because what's interesting is all investors behave the same. When we get excited, we do diligence, right? One of the ways we do that, for example, is you might follow the founder on AngelList. Now that one action on its own doesn't matter. There's no meaning, there's no context. But if you, as a single investor, follow that founder on multiple channels, you're getting interested. I don't know whether you'll invest, but I can tell that you're interested. And if you zoom out a little bit more, all of a sudden what you might recognize me telling you is, if I see multiple investors converging on a single founder, well, at least now I know which founder I should go talk to, right? If this does, and by the way, don't drink my Kool-Aid. If you think this is wrong, say it. Right? But I've bet a lot of money using strategies like this. This is very, very hard to do, but the payoff is very high. And what I mean by that is my business, right, for example, and I'm going to show you how I do it in a little bit here, but is I write a small check at the beginning, but for the investors in here, you'll recognize that in order for that model to work, I have to be able to place the second check properly. I have to write a bigger check on the second check, right? Right? Because I want a bigger stake in the company. So here's the beauty of this whole system. If I can see one of my founders is looking to raise money, let's assume for a minute that they don't come tell me they're raising money, which is a different problem. But if I can see the market getting hot on them, well, not only can I invest, but maybe I can actually intercept. Meaning, if I know who the key players are that are getting excited, and I know what their usual valuations are, what if I could insert a check as a bridge round at like a middle valuation to get another step function up? And now we're talking about real gains. And that's one of the reasons why our own internal rate of return at 500 startups is relatively high. I mean, I'll tell you guys offline, but it's good. It's good. And then the third thing is we use this stuff for faster portfolio trends, right? How many times have you heard other investors say stuff like, well, we believe the market's going this way, or we believe we're going that way? You've probably heard it a lot, right? All right, look, at my firm, I don't want people saying I think or I feel. The data tells us everything. And so what we've actually done with our systems is plug directly into all the portfolio companies. I call it data porn is what it is, right? Like when you open the activity stream on our systems, you see an activity stream that shows new signups, return visitors, paid upgrades, everything. And now, from an LP standpoint, for my investors, I can give them nearly real-time data. And for me as an investor, I can see trends as they happen. I don't have to go out and make stuff up. For those of you that have invested in other funds, you're probably used to a quarterly and a LP report, right? We do that plus a monthly report. In fact, we could do a report every day if we wanted to, but we delay it by 30 days just because the administrative burden is too high, right? But this I think for the investors in the room, this is what's going to change our industry is real-time reporting, right? In any case, That did not come out right. I will upload the right one. But these, the text should be black here. I'm sorry. But the point here is that we also use a checklist. And that checklist, I know this is really hard to read, but for example, let me just start by saying that when you go to the casino with me, I'm the most boring guy to play with. Unless you like making money, then I'm really cool to hang out with. And the reason I say that is that, like, look, we are all, founders, investors, everybody, we are all walking into the same casino. We all know the odds are against us. And if you want to go out and have fun, you can. But when I walk into a casino, I have a thesis that I'm going to play against. And this is my thesis, a big part of it, right, is I have a checklist on every deal. If a founder does not meet these checklists, right, I walk away. It doesn't mean you're a good or bad person. It doesn't mean your business is bad. It just means it's not a good fit. So for example, one of the things is I want a specific target customer. And here in India, what's interesting is you hear a lot of stuff about we serve the bottom of the pyramid. Well, that's not a specific target customer. Thank you, but no thanks. Right? The other alternative is that, especially Indian founders, I've been coaching founders all morning, so this is like fresh in my mind. All of their products are like the kitchen sink, man. Everything's in there. Like they do this, they do that. Like if you were to give them an extra year of runway, they'd probably like code something that solves world hunger. The point is get a specific target customer. That's what I want. I want the team to be in place. Hacker, hustler, and designer is what I call it. Hacker, hustler, and designer. I don't care if you have that in one person or spread out across five guys and girls, right? I just want the team there. No outsourcing, not having your brother-in-law build it. The team better do it, right? I require a functional prototype. I require small but meaningful traction. I would love it if you have 10,000, daily active users or something, but that's not legitimate, or that's not reasonable. But I do want you to actually get an inch off the ground. Again, I'll change the slides out. And actually, if you go to grab this online, the text is black. I don't know why it switched here. Okay, so that's the startup side. And the fact is, so cliche number 2 is it's already forced the early stage venture side to change. Right? Now, here's the dirty secret about my industry and yours, investors, is that the state of the art in our industry is not very advanced at all. Right? It's not. I mean, let that sink in for a minute. What have we done for the last 50 years as an industry? I feel good about that business. Right? At the early stage. What do we say? Well, I feel good? And you guys are nodding, but nobody's actually tried to do anything different. That's where we get into Moneyball. And Moneyball, I'm stealing the word, but did everybody see that movie? Okay, so the summary for those of you that didn't see it is Moneyball is a statistical theory that was used with the Oakland Athletics, which is a baseball team in California. And it's in one of the books that I mentioned earlier. The point here is that using these models, the Oakland Athletics built a team on $40 million and achieved nearly the same results as the New York Yankees that spent over $150 million that year. Okay? For those of you that are price conscious, they got nearly the same results for $40 million instead of $150 million. And for the investors in the room, what I'm really about to show you is that I can get you big returns. Let me rephrase that. I have been able to get good returns using a theory like this. My hope is that everything I show you here will encourage you to think about what your thesis is. You don't have to follow mine, but you should have a thesis. So, the thing I always tell people is what I'm talking about, investing in 150, 200 companies a year, you might call it spray and pray. I call it a process, right? My business, and I'm going to make an assertion that your business as investors is to buy into wins. Not to get into any business that's on TechCrunch or all these other things. We buy wins, right? I know this isn't rocket science, but this is really important that you understand the frame. I don't want to buy into the hottest deal. I want to buy into the winning deals. The fact of the matter is that the initial investment is only designed to get you access to the next round. Does everybody understand that? The initial bet is not where you're going to make most of your money, and I'll show you why. It's where you're going to guarantee that you will be at the table when that deal is ready for an investment again. Okay? It's a quantitative portfolio approach. This is the meat. We don't have enough time to go through this, but let me first summarize by saying that when I started thinking about this stuff, right, the problem is that when you go out and look at like venture returns out there, right, The problem is the only reports that are published by other VCs and other angels are the good ones. Right? Because if you investors, just like me, if we look at each other and say, how's your portfolio going? We're not going to say, oh shit, I lost one of my CTOs, just bailed on me. We're going to say, no, life's good. Life's good. Returns, oh man, I got like a 90% IRR. Right? We're going to say crazy stuff. I'm 30x up. Right? All right, so my point is that real data doesn't exist. The data that's published is typically biased towards the optimistic side. So without that data, you actually have to use one of the simulations you can use is a Monte Carlo simulation. Again, we don't have time to get into it, but in a nutshell, the point is that I created a hypothetical world with hypothetical investors, hypothetical founders, right? And I then simulate with a bunch of assumptions I've made, simulate what an investment community would look like and what the outcomes would look like. And then I run that simulation millions of times to see what will actually happen from a probability standpoint. So let me just fast forward. How many deals do you have to do to get a 1x return? Investors or founders. How many deals do you have to do to get a 1x return on your money? I don't know either, but it was actually a trick question. Because you should be, the two words that you should be thinking about is, did he ask 1x average return or median return? 5 deals will get you a 1x average return. The problem is the median, this graph, this is not on this graph, so don't look at this graph. The thing is 5 deals will get you a 1x mean return, average return, which means you will get your money back. The problem is the median is what we call it a walking median. It's unpredictable. You might have 5 duds, you might have 5 Facebooks. So the mean and the median are diverged, right? Okay. All right, let's just fast forward. So how many deals do you have to do to get the mean and the median outcome to converge? Well, it's not infinite, I hope, because then I'm screwed too. So 500, no. That's a good guess, though. 123. Think about that. You have to do 123 deals to get an average 2.3x return where the median is converged with the mean. Investors, you should be depressed. Because if your portfolio has 5 deals in it, you're in trouble. Now look, I'm not discounting that you might be able to pick the next Mark Zuckerberg, but I'm openly admitting that I don't know how to find that person. Right? So what I'm going to talk to you about is how I index the entire market. I find the winners. I'm the card counter at the casino. Right? All right, so high volume investing. I'm going to do 250 investments in each one of my funds. That's how I operate, right? So I double the 123 number, and I get to 250. That's my insurance policy. But make no mistake, there is a high failure rate. Here's the dirty secret, though. My failure rate might be perceived as higher than yours, but actually it's statistically the same, right? 80, 90% of our portfolios are going to fail. If you've only done 10 deals and you see 8 failures, you're going to feel better about yourself than I do when I do 250 deals and 80% of them die. This is important that you understand this because if you go into a quantitative theory, you must prepare yourself for what appears to be higher failure. But when you think about it from percentage standpoint, it will be about the same. For the angels in here, this talk is usually for an angel education kind of seminar. So one of the things I encourage people at this point is to really think about internal rate of return and stuff like that. I'm going to fast forward here a little bit. The other beauty of this kind of model, by the way, for the investors here is that your portfolio internal rate of return can get positive very quickly, right? Because don't forget that you can actually mark up for later stage equity rounds. And smaller exits do happen, right? Like I don't actually worry when somebody buys my company for $5 million because I probably got in at $1 million anyway. 5x return in a few months isn't bad. I'll take that. Let everybody else find their IPOs. I'll take the 5x all day. Smaller exits can move the needle. And don't forget, as angels, by the way, you can sell your position to VCs like me downstream. Right? As long as